What's up guys, it's Warren Gosling here once again with simple, actionable financial literacy tips. If you find my channel and my content useful, do two things for me: subscribe and comment and like. Three things. It really helps the channel grow. The YouTube algorithm seems to love it when you do that, so I'd really appreciate it if you did that. So today is a follow-on from last week's video where I showed you everything that's inside of my funds, stocks and shares portfolio. Full transparency guys. So if you want to know what I actually invest in, give that video a watch. The link is in the description below. Now today what I'm going to do is I'm going to review my portfolio together with you guys right now. So when it comes to funds, my strategy is to take medium to high risk. Why? Because I'm young, relatively, and I'm building my wealth. I'm at that stage of wealth building in my life. When I get to 50, 60, I'll likely reduce the amount of risk involved because I'll be at a stage in life where I want to consolidate and protect my wealth. So that's my strategy when it comes to risk. When it comes to diversification, that's a big word guys. I diversify my investments by exposing myself to a range of different industries and the global economy, not just the UK and the USA. Home bias is something that a lot of us fall into through no fault of our own really. And this is essentially where we tend to predominantly or even exclusively at the extreme end invest in US and UK companies. Why? Because it's where we live guys, and it's a culture we're exposed to. We're exposed every day to US and UK companies, and we actually end up ignoring all of the other huge companies across the rest of the globe, across the rest of the planet, which are just as big, just as successful and just as profitable. So that's my strategy in terms of diversification. When it comes to dividends, I reinvest all of my dividends back to buy new shares to compound growth over the long term. And then lastly, I'm a long-term investor guys. I'm not looking to sell anytime over the next 10 years, even at the very least. I buy and hold. So I mentioned before that when I invest, I wait 3 to 5 years before I look at the performance and start even thinking about making any changes. Why? Because less than that isn't long enough, guys, to build a reliable track record of performance that you can meaningfully analyze. You need to give your funds enough time to perform before you start scrutinizing their performance, going through them with a fine-tooth comb and a microscope and looking at what to change. Think of it like being a football manager, guys, and having an academy player.
Talking about them all week, Steve. I mean, I think the crowd have got that excited and expecting miracles off this kid.
When they're fresh out the academy and they're just coming into the first team, you can't judge them after 2, 3, 5, or even 10 matches, guys, or even a season. They need a couple of years to develop. And then only after that can you really say, you know what, mate, you're not going to make it here. And you send them to Maxwell Town on a free transfer.
Yeah, I'm pleased that has happened, and I'm pleased to be here.
It might break your heart to let a fund or a stock go, but not every academy player or academy stock can turn into a Ronaldo or Messi, can they? So funds are much the same, guys. Give them time, guys. Just a quick pro tip for you guys there. So I'm investing in 7 funds, 3 of which I've had for almost 4 years, and 4 of which I've had for just over a year and a half. So I'm only going to focus on reviewing those which I've had for over 3.5 years. It's too early to make any changes to the ones that I've only had for a year and a half, guys. They need more time to do their work. So I'll review those in another video once I get to the 3-year mark. So for the 3 funds I'm going to review with you today, in terms of how I'm going to review these, I'm going to look at the actual performance versus the benchmark performance. Now, what do I mean by this? Well, each fund is made up of stocks and or bonds across certain countries and certain sectors. So for example, one of my funds that we're going to review today is called the PicTech Digital Fund. We'll come back to that later, which is made up of digital company stocks such as Facebook, Google, Alibaba, Tencent, etc., which are based in the UK and China, among other countries. So when it comes to comparisons, this fund's performance will be compared to other similar technology funds that have technology stocks in them to give you an idea of how it's performing against its like-for-like peers. And just to flesh that out a bit further, guys, so it wouldn't make sense to compare the PicTech Digital Fund that I've just mentioned to, say, an energy company fund or a retail company fund or a banking company fund, because these sectors sell completely different goods, offer different services to different customer bases, so they're not comparable. Okay, do you see my point? So let's look at how to review your portfolio step by step. I'm going to start with my PicTech digital fund. The first step is to check your actual return for the period. Your platform will have this calculated for you. They should do. Now, this is a screenshot from my platform, Fidelity, that I use. And you can see that the return for the last 3 years has been 42.6%. Now, the next step is to look at the benchmark performance for similar asset classes that I just mentioned. This should also be calculated for you on your platform, and it should look something like this. As you can see here, the trailing returns for similar equity tech companies over a 3-year period is 18.7%. Equity is just another word for stocks, by the way. The third step is to compare the actual return that we mentioned at the beginning to the benchmark performance that we just saw now. So we have an actual performance of 42.6% versus a benchmark sector performance of 18.7% over a 3-year period. So guys, we can clearly see that the actual performance has blown the benchmark performance out of the water. My fund has outperformed its comparable peers by more than double. And obviously I'm very happy with that. We're gonna keep calm and carry on with this particular fund. All good in the hood, no changes here. I'm gonna hold on to it, okay? So that's how I review my portfolio in 3 simple steps, guys. It's that simple for me. Now, let's do the same thing again for the 2 other funds. Next up is a Jupiter distribution fund. The first step is to once again check the actual return for the period. Here's a screenshot from my platform, and you can see that the actual return for the last 3 years is 2.1%. The next step is to compare the actual return once again to the benchmark performance. So we have an actual performance of 2.1% versus a benchmark cautious investments performance of 1.8% over a 3-year period once again. So guys, we can clearly see that the actual performance here has again outperformed its comparable benchmark performance, not by as much of a degree as with my PicTech digital fund that we just looked at, but it's still ahead. So that's great, right? We're gonna keep calm and carry on and keep this stock.
Okay.
No, we're not. This is a great opportunity to show you guys how I tie in my strategy that I mentioned right at the beginning of this video with my review. So I said at the beginning of this video that my strategy is to take medium to high risk because I'm young, I'm at a wealth building stage of my life. So what I'm going to do is remove this fund from my portfolio and replace it with a higher risk fund, which achieves this. It's higher risk, not massively, and higher returns. So what I'm going to do is sell all of the units that I have in this Jupiter distribution fund and use that money to buy up this new fund that I've found. If you want more info on this new fund that I've found, let me know in the comment section below, and I'll make a separate video on why I chose that one. So that's what I'm going to do with the Jupiter distribution fund. Now lastly is the M&G managed growth fund. The actual return for the last 3 years is 2.5%, and the benchmark performance for similar adventurous asset class funds is 2.8%. Now, when we compare the actual return to the benchmark performance, we can see that the actual performance that I've earned is 2.5% versus a benchmark performance of 2.8% over a 3-year period. So guys, the actual performance here has underperformed the benchmark peers performance. And again, similar to the fund that we just looked at previously, I am going to sell the units that I have in this fund and buy into another new fund. Why? Because firstly, this has underperformed over the past 3.5-year period versus its peers. And I also want to replace this fund with another fund that takes a bit more risk and has higher potential returns. That's my strategy that I want to pursue, guys. So you might now be asking, why did I start off with 2 low risk, low return funds, despite having just told you that I want to take more risk and build wealth? That might seem like a contradiction to you guys, and I'm very aware of that. Now, the answer to that, guys, is that I picked up these funds right at the beginning of my investing journey when I was brand new to funds, brand new to investing. So I made a conscious decision to take baby steps into investing into this whole world of funds. And I chose low risk funds to begin with. That was my initial short-term strategy, call it that. And then what I wanted to do over time, as I got more knowledgeable and confident in the area of funds, progress towards more risky funds. So that is exactly what I'm doing today. I'm tweaking my strategy to take on more risk and aligned to my overall strategy, which is to build wealth, take risks at this stage of my life. So that's today's video, guys. I hope you found it useful. If you have any questions, let me know in the comment section below. Please consider subscribing and liking. You guys have a good week, and I'll see you next time.